In the next few hours, one announcement from Jerome Powell could flip the entire financial system on its head and push gold toward $5,000 or even higher. Most people won't see it coming. Most won't react until it's already too late. And that's the painful truth. Everyday Americans are walking straight into a historic shift with zero protection, while the biggest players in the world quietly prepare for impact. If you've been watching your savings shrink, your paycheck lose power, or your investments swing like a roller coaster, you already feel the pressure. Inflation has been eating away at purchasing power for years, job numbers keep flashing warning signals, and confidence in the system is fading fast. Yet the people who control monetary policy are backed into a corner unlike anything we've seen since the 1970s or the early 2000s. No good choices, no clean exits, only consequences. That's why this moment matters. On December 10th at 2 p. Eastern, the Federal Reserve will make a decision that could ignite one of the most dramatic moves in gold we've witnessed in modern history. Some of the largest institutions on earth, JPMorgan, Goldman Sachs, Bank of America, Vank are already calling for massive upside. Even Jamie Dimon has floated the possibility of gold reaching $10,000 in today's environment. Most people will ignore these signals, but if you understand what's been building for 13 straight months beneath the surface, you won't. Stay with me until the end. What you're about to hear may redefine how you see the next year of your financial life. And here's where the pressure tightens. The Federal Reserve isn't walking into this meeting with options. It's walking in with a trap that's been building for more than 4.5 years. Inflation has stayed above the 2% target for that entire stretch. It never truly cooled. It never gave the Fed the breathing room it needed. And now, as prices stay elevated, the job market is starting to crack. Analysts say unemployment is weakening faster than anything we've seen since 2008. That year still sits in America's memory for a reason. When jobs fall and prices stay high, families get squeezed from both sides. And the Fed is forced to choose which pain spreads faster. If they cut rates, inflation can flare up again. If they hold steady, the job market may take a deeper hit. Either direction triggers fallout. That's why gold has already surged roughly 60% this year. Investors aren't guessing. They're reacting to the pressure building inside the system. And if you step back, this pattern isn't new. Financial historians point to two major moments where the world shifted almost overnight. On August 15, 1971, President Richard Nixon closed the gold window, disconnecting the dollar from its anchor, the U.S. codes. Currency became backed only by faith. Smart money saw the consequences immediately. Gold jumped from around $35 to nearly $850 by 1980. AIG had to be rescued. Gold didn't just go up, it ran from roughly $271 to around $1,900 by 2011. Both times, the same formula appeared: pressure, loss of confidence, gold explosion, and now in 2025, the ingredients are lining up again. Only this time, two triggers may be firing at once. That's why the next 48 hours matter more than most people realize. And that brings us to what's happening right now. Gold sitting near $4,212 isn't an accident. It's a signal, one of the clearest we've seen in decades. Because when you look under the surface, the economy isn't humming along the way the headlines suggest. It's flashing warnings in every direction. Recent ADP reports show a loss of about 32,000 jobs, not slower growth, not a miss, an actual loss. At the same time, Challenger layoffs in November hit roughly 71,001 of the highest readings since both 2008 and 2022. Those weren't calm years. They were bear market years. Year-to-date layoffs have reportedly pushed past 1 million, up around 54% from earlier estimates. And surveys say about 40% of companies in 2025 have already cut staff, with nearly 60% preparing possible layoffs in 2026. That's not stability. That's stress building from the inside out. Yet inflation is still hovering around 3%, climbing from roughly 2.3% back in April. People feel it every day. Energy, food, services. Analysts are pointing to tariff policies, supply chain strains, and rising production costs. And with more tariffs expected in 2026, the trend doesn't look like it's slowing, it looks like it's tightening. This is why the Fed is stuck in a corner. If they cut, they risk pushing inflation back into overdrive. If they hold, they risk sending job losses into a deeper slide. Either way, the pressure doesn't disappear. It shifts, it spreads. And markets can sense when a system is backed into a decision it doesn't want to make. This is why today's Federal Reserve meeting is shaping up to be one of the most divided sessions in modern history. Economists expect at least 2 dissenting votes, maybe even 3. The last time we saw 3 was around 1992. When policymakers split like that, it's not random. It means something bigger is moving beneath the surface. And while most people are focused on the headlines, they've missed the slow, relentless behavior happening for 13 straight months. A behavior that may explain why major institutions are bracing for gold to make a move no one's prepared for except the people paying attention. And here's the part almost no one is talking about. While the US economy has been throwing off warning signals, something else has been happening quietly, consistently, and with far more intention. For 13 straight months, China has been buying gold, not slowing, not skipping a month, buying every single month without interruption. Their reserves have grown to roughly 74 million troy ounces, valued at more than $300 billion. And they aren't the only ones repositioning. Turkey, Poland, India's central banks across the world have been accumulating gold at a pace that now exceeds 1,000 tons per year, about double the 10-year average. That is not casual investing, that is preparation. Preparation for what? Look at the backdrop, the US. National debt has climbed to about $38 trillion, up from around $36 trillion just a year ago, an increase of almost $2 trillion in 12 months, and projections show $2 trillion deficits continuing year after year. Foreign central banks see this trajectory. They see the political gridlock, the endless borrowing, and the relentless money creation, and many are now quietly reducing their exposure to UK's treasuries. When confidence in government debt fades, reserves need a different home. A neutral home. A home that doesn't depend on any country's policy decisions. That home is gold. Industry analysts say this shift marks one of the strongest official buying streaks in modern history. It isn't a trend, it's a signal, a shift in the monetary architecture itself, and it's happening right now, even if most people haven't recognized it. Now, let's talk about what this means tactically. Gold trading near $4,212 sits just below a critical line. If it moves through $4,264 after the Fed announcement, it could open the door to the $4,381 zone near the all-time high. And if gold breaks that level, momentum changes, psychology changes. Suddenly, the path toward $5,000 doesn't look extreme. It looks like acceleration. But the metals market isn't the only place pressure is building. Something even more explosive is developing in the mining sector. A force that could magnify every move gold makes 2 times, maybe 3, and it's unfolding at the exact moment the Fed prepares to shift direction. Before we dive into the mining surge, you need to understand the spark that may light the fuse. Something major shifted on December 1st. After almost 2 years of shrinking its balance sheet and draining liquidity, the Federal Reserve quietly ended quantitative tightening. No more reduction. No more tightening cycle. And if the Fed cuts rates this Wednesday, it won't just pause the fight against inflation, it will reverse it. More liquidity, cheaper money, easier conditions across the entire system. Every historical pattern points to the same outcome. When tightening ends and rate cuts begin, gold rallies. Not occasionally, not sometimes, every single time. And this time, the backdrop is far heavier. The US is carrying around $38 trillion in debt. Inflation remains above target. Geopolitical tensions are everywhere. Central banks are shifting away from the dollar and accelerating gold purchases. All of these forces are converging at once. Analysts like Ryan McMillan from Merkle Tree Capital say the setup isn't just bullish, it's primed. The rate cut might not be the rally. It might be the trigger. Now, let's look at the part most viewers overlook. Gold has climbed about 60% this year, but gold mining stocks, they've surged roughly 125%. According to sector indices, their estimated all-in cost to produce an ounce sits near $1,600. With gold around $4, 200 miners are capturing margins close to $2,600 per ounce record levels. Unlike past booms, they aren't burning cash or over-leveraging. They're cleaning balance sheets, paying down debt, and buying back shares. If gold hits $5,000, miners won't move 10% or 20%. They could move exponentially. That's why analysts from Morgan Stanley and Jeff are calling for heavier portfolio allocations, to gold some reaching 20% with upside targets stretching towards $6,600. And if miners follow with 2 times leverage, Triple-digit returns aren't a fantasy. They're a scenario, one that smart money is already positioning for. So let's zoom in on where we stand right now. It's December 10th, 2025, just hours before the next Fed decision. Gold sits around $4.212, and the world's biggest financial institutions are no longer cautious with their forecasts. JPMorgan sees gold pushing toward $5,000 by 2026. Goldman points to roughly $4,900. Vance expects $5,000 by 2030. And then there's Jamie Dimon suggesting that $5,000 to $10,000 gold isn't irrational in the current environment. When conservative voices begin making aggressive predictions, you know the ground is shifting. Meanwhile, the underlying forces haven't changed. China has been buying gold for 13 straight months. Central banks continue accumulating an estimated 1,000 tons a year. And the Federal Reserve is still trapped between two outcomes. It desperately wants to avoid higher inflation or a deeper recession. They can soften the tone, they can adjust the language, but they cannot escape the math. This is why the upcoming FOMC meeting is expected to be one of the most divided in modern history. When policymakers disagree at that level, markets feel it, confidence breaks, and gold thrives in the vacuum created by uncertainty. What we're watching is the collision of two historical playbooks: the 1970s, when currencies lost their anchor, and the 2000s, when central banks printed without restraint. Today, those forces aren't alternating, they're overlapping. Debt is exploding, trust is eroding, geopolitics are unstable. Central banks are repositioning away from the dollar. That's not a normal gold rally. That's the blueprint of a monetary reset. So when Powell steps up on December 10th at 2 p. Eastern, everything he says or doesn't say will matter. A dovish tone could send gold ripping higher. A hawkish tone might, but when you step back and look at the full picture, the path becomes hard to ignore. The debt won't shrink, central bank buying won't suddenly reverse, and the dollar, for all its history and influence, is no longer moving through the world unquestioned. Gold has been money for almost 5,000 years. The dollar has existed in its current form for about 52 years. Ever since Nixon shut the gold window. One is ancient, one is young, and one of them is being tested right now. That's why every call of overpriced has failed. At $1.800 in 2022, critics dismissed it. At $3,000 in 2024, they said it couldn't go higher. At $4,000 in 2025, they called it a bubble. Today, near $4,200, many still refuse to believe what's in front of them. But major institutions aren't hesitating. Goldman isn't hesitating. China isn't hesitating. They're preparing for a world where gold plays a much larger role. And that brings us to you. Because at this point, the question isn't whether gold can reach $5,000. The question is whether you recognize the pattern. Whether you see the same signals that have repeated across decades. Whether you act while the window is still open or watch it close from the sidelines. Later today, Jerome Powell will speak. He may sound dovish. He may sound cautious. He may try to cool market expectations, but once the announcement hits, momentum will take over. A softer tone could push gold sharply higher. A tougher tone might create a brief pullback. But the long-term setup, it's locked in. The forces behind it aren't temporary, they aren't emotional, they're structural. This moment could be the turning point people look back on years from now, the moment they realize the shift had already begun. Stay with this channel, because in the next video, we break down what Powell might say, how markets could react, and which opportunities could multiply over the next 12 months. This is only the beginning. The move toward $5,000 gold isn't fantasy. It's the destination we're heading toward, and the road signs are everywhere.